please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But let's find out what the industry is made of it. Ashwini Kumar Hooda, the Deputy Managing Director of Indiabulls Housing Finance, joins us to outline the impact. We will also chat about the revised affordable housing limits. Ashwini, good morning. First, on the 10-year yield, it's crossed that 8% mark. What kind of impact do you have? You know, funding costs have in any case been moving higher. What impact do you see on the industry and for your own company?
So interest rates have started moving in last 6-7 months, and while the bond market, the money market factors in the future increase quickly, the system-wide rate increases will slowly come into effect. So we have seen home loan rates which were around 8.3% rise to 8.5%, and for the old customers, PLRs or the MCLRs have been revised by 20 to 30 basis point. So from a house perspective, it does not really impact much as yet. 4.5 years back, when GSEC was at similar yield, the home loans were at 10.75%. So there is a huge climb down in interest rate and affordability as its highest in Indian history. So combined these, the demand will continue to be very strong in housing. In fact, we are seeing early signs of growth in the premium and the mid housing, which was slow in the past. So our sense is both affordable housing and premium housing will grow very well going forward.
Yes, Ashwini, but it doesn't leave housing finance companies in a very sweet spot, does it? Because, you know, your lending rates, as you pointed out, aren't where they used to be, 10% plus, whereas the cost of money is shot up, you know, very, very quickly. We saw a bit of that impact. There was some minor compression in spreads, I think, even for you in the fourth quarter. What should we expect now in, you know, Q1, Q2, maybe a first half guidance, if not the full year guidance, if you can give us?
So the spreads, if you see, came down last quarter because we postponed the rate hikes. Feb and March are very big business months, and we didn't want to disturb the marketplace. But from April onwards, in last 2 months, our book yields would have gone up by 30 to 40 basis point, whereas our cost, if I look at on a historic basis, have only gone up by 20 basis point, and it may be unique to Indiabulls Housing that we were upgraded to AAA by CRISIL and ICRA last year, and as a result, our borrowing costs are down 60 basis point on a apple-to-apple basis. So the cost impact on Indiabulls Housing, it will be minimal in this rate cycle because of that 60 basis point of spread savings. Having said that, housing finance companies are pure pass-through vehicles. We have seen over last 20 years many, almost 4 interest rate cycles, and each of those cycles housing finance companies have been able to pass on any rate increases to its customer, and 99% of our assets are floating in structure, and hence we see ourselves as a conduit of interest rates. It is the demand which really is of interest to us. Last time in 2011-12, when interest rate rose up by 200 basis point, there was a slowdown in demand. This time around, because of higher affordability and hopefully interest rate won't rise 200 basis point plus, we believe demand will not be impacted.
So just to clarify, Ashwini, you mentioned that April onwards you have undertaken certain hikes on the lending side. Have you entirely passed on the increase in market rates to your customers? I mean, have you factored in fully the yield at 8% now with these rate increases, or will you hike more? And if you could then give us a guidance on the spreads, should we then expect, since now rates are going higher, should we expect the spreads to go back to maybe 3/4?
So our spreads definitely will be in range of 3 to 3.25%, and I believe that we should be on the higher side of that margin range after PLR hikes in the recent past. You must appreciate that the fixed income market will factor in the rate hikes that will come over. Let's say I'm borrowing 5-year money, so they will factor in rate hikes that will come over 2-3 years. So those yields are up 100 basis point. But I have an option, and I exercise that option to convert those fixed rate into floating rate, which are linked to to MIBOR, which is linked to again repo rate. So we have only seen 25 basis point increase in repo rate in the last RBI meeting, and that is the only increase in the floating rate cost if you have to compare last year versus this year. So as long as I can convert my fixed rates to floating rates, and the floating rates have shown only 30 basis point increase, and which is what I passed on to my customer, my margins will be intact.
Okay. Well, for home buyers, there's a lot of good news, right? I mean, the RBI has hiked this limit on loans under affordable housing now to 35 lakh rupees. What have you made of this? I mean, how does it impact the sector? How does it impact your own company?
So it's a continued positive measure that both RBI and government have taken to support the mid-income housing, because clearly it is, apart from a social objective, seen as a economic objective as well, because this industry, which is currently growing at 18% has a potential to grow 25% over next 12 to 18 months, and being a 6 to 7% GDP contributor, and so many allied industries also benefit. I believe the government and the RBI are doing their best to encourage this sector. A huge limit. They've increased the priority sector limit by almost 25% in metros and 40% in non-metros. Means now almost a house of 45-50 lakh, which will have a loan of 35 lakh, will qualify as priority sector for banks. And for originators like us, that means lower cost of funding when we securitize these loans to banks. So this is a step in right direction, and this will also minimize the rate increase for this category, home loans up to 35 lakhs. The rate increase will lag to the rate that, let's say, above 35 lakh or 50 lakh, which other home loan borrowers will pay. So I think it's a very good step, and it will really help the entry level affordable housing.